Welcome students. I am Punjika Rathi, Assistant Professor, IMS Engineering College, Ghaziabad. Today we will discuss about insurance and equity. These are two investment options which are available in our country. Insurance is basically risk protection measure where one can invest as well along with transferring the risk from the insured to the insurer, and equity is also a kind of investment avenue where one can expect a higher rate of return, but yes, it is risky. So, let us start them in detail. Insurance, the term insurance has originated from a term which is assurance. Assurance means yes, there is someone who will take care of you when you are in need. So, there is some party, there is some organization which is there for you, which would provide you losses, which will make good your losses when you are facing some problem. So, that is how the insurance has originated in the country as a product. Insurance is, if we say insurance, it is made up of two things, assurance plus investment. So, when you are assured that your risk, somebody will take your risk and you will also invest your money. So, that becomes the insurance. Basically, insurance is a product to transfer the risk of the insured to the insurer. So, what happens is, it is a kind of legal agreement, it is a contract. If we say it is a contract where one party, which is called as insurer, in consideration of price paid to him, that party bears the risk associated, and this party takes a consideration in taking this risk. So, the one party in consideration of the price paid, which is the premium, and this party agrees to bear the risk of the other party. And why it is taking a risk? Because that party says, the insurer says that the insured should not suffer losses, damage or prejudice by the happening of certain specified events. These events becomes the peril. These events are the risky events, because these events would make some loss to the insured. So, insurance is meant to protect the insured against the uncertain events which may cause disadvantage to him. So, we can also say insurance is a product where one party agrees to bear the losses of another party in consideration of some money, which is called as premium. So, this is how the risk is being transferred from one party to another party, and since one party is taking the risk, so that party would require some consideration. As we know that it is a contract, it is a legal agreement. So, how these things would come in place? These things would come in place through a document which is called as insurance policy. This insurance policy would give all the details regarding the insurance, when the sum assured would be provided, what are the terms and conditions, what is the risk being covered by the insurer. So, this is the basic concept of insurance, where one party is transferring the risk and second party is bearing the risk. Why? Because that party is paying a premium. So, because that party is paying a premium, so that is why that is how the product is being evolved. The elements of insurance product. These are some basic terms associated with the insurance product. One is insurer. Insurer is that party which is taking a risk. So, we can say the insurance companies are there who are taking the risk. For example, there is LIC, there is HDFC Ergo, there is HDFC Life, there is SBI Life, there are large number of companies who are taking the risk. Then second party whose risk is being provided or transferred, that party is called as the insured. It means the client, the policy holder is called as the insured, means whose risk is being insured, the policy holder's risk is being insured. So, that person is called as the insured person. And then consideration is the amount which is paid by the insured to the insurer. Why? Because he is taking the risk, that is called as the consideration, and we can say it is a premium, it is the premium. This premium can be paid, it can be quarterly, it can be yearly, or it can be a one time payment. Then there is a sum assured. Sum assured is that value which is to be provided by the insurer on happening of the event, on happening of that contingency for which insured has taken a policy. So, that amount is called as the sum assured, means that lump sum value that, or we can say that since the insurer is taking the risk, so what up to what extent he is taking the risk, that amount in, if we convert into some financial numbers, into some money numbers, becomes the sum assured. Then risk covered. What is the risk is being covered? Means what is the risk, what is the peril is being covered, what loss is being covered. So, the risk can be covered related to life, or it can be covered to non-life. For example, there can be risk of fire, there can be losses of property of a person by the fire, there can be loss of income to a person because of the death of the person. So, there can be there are different kinds of risk being covered by the insurance. Then agents, agents are these are the part of distribution channel of the insurance company. They sell the insurance product to the insured. Why there is a need of agent? Because as the term suggests, agent is somebody who is doing the function of the principal. Who is the principal? Principal is the insurance company, and this insurance product, because it is related to money. So, that is why there is some person who should build a trust of the insured on the insurer, that there is a insurer who would pay the money in times of the need. So, that is why agent is very important in this insurance industry. Then there is a nominee. Nominee is a person who would get the money, who would get the sum assured in times of the need. So, that is also being given in the policy. This whole thing is being it is being explained in the policy in minute details. Advantages: insurance, since it is a product where the risk is being transferred. So, number one primary objective of insurance is that there is protection of risk. If there is some loss, so the insurer would make good the losses. Pooling of losses, what does it mean? It means because the policy holders, they pay a premium, they are contributing. So, what happen is insurance company generates a pool of money with it, and this pool, with this pool of money, the insurance company pays the sum assured to somebody who has occurred some losses. Due to this insurance, there would be reduction in tension and fear. A person would feel secure if he is having an insurance policy. There is credit multiplication in the country because of the insurance. Why? Because insurers, they have to invest their money into different instruments in the country, and this is how they generate returns, and this return is again invested. So, this is how money is being created, is being multiplied. So, that is why we are saying there is credit multiplication. We are saying it is even investment avenue. Yes, sure, it is an investment avenue where a person can not only protect himself from the risk, but he can also save a money from these contribution and can get back that money along with some return or some minimum rate of return. So, that is how our habit of saving can be developed with the help of insurance policy. Generally what happens is salaried class, they go for insurance. There are huge tax benefits associated with the insurance. If you purchase insurance, you will get benefits on the premium paid. So, whatever amount of premium you are paying, that would be treated as tax reduction in the tax liability of the insured. There is a facility of loan as well. It means the insurer will also provide loan on behalf of insurance policy. So, this is how people can be protected from not only from the losses, but yes, they can also get financial help from the insurer. it promotes the saving and investment in the country as a whole. When people are purchasing, it means they are contributing towards investment, and insurer are also contributing towards the priority sectors of the economy, and this is how the economy can grow. There would be the capital formation in the economy, and this capital can be invested into long term projects of the country. So, that is how insurance is not only important to the insured, not only important to the policy holder, but yes, to the economy as a whole, to the nation as a whole. That is why we are focusing on the insurance. There are some fundamental principles of insurance. Insurance works on some principles. Number one principle is utmost good faith, principle of Uberami Fidais. It means that there should be good faith between two parties. Who are the two parties? Insurer and insured. I am denoting insurer by IN and insured by ID. So, it means there must be mutual trust in both the parties. It means all the relevant information has to be disclosed by the insured as well as by the insurer. It means if somebody is taking a life insurance, that person should disclose the health conditions, his health conditions, or what other insurance he has taken. So, this means that he is disclosing all the minute details, and same goes for the insurer as well. He should also disclose what are the hidden terms, what are the conditions, when the sum assured would be provided, how would the claim would be settled. So, these things should be discussed. There is a principle of indemnity. What does it mean? That this insurance works on the principle of making good the losses, making good the losses. It means that the objective of insurance is just to make good the losses, not to give you benefits or the profits. It means no person should earn benefits from the insurance, he should only earn the losses. He should only get that amount by which his losses can be compensated, but he should not get the amount as a profit out of the insurance. But yes, this principle is not applicable in life insurance, because nobody can quantify life in money terms. So, this is not applicable in insurance. In simple terms, if I say principle of indemnity means no person can take more than one insurance for a same subject matter. For example, if you take motor insurance, you take health insurance. So, for the same loss you cannot get contribution from different insurers, because if you are taking this, it means you are generating the profit. But the objective of insurance is just to make good the losses, not to provide profit out of that. There is a principle of subrogation. It means insurer if pays the contribution, if pays the sum assured, he would get into the shoes of the insured. It means whatever the legal remedy is with the insured, that same remedy would be also applicable to the insurer. It means if there is some losses to the insured by third party and insured can take some legal remedy against the third party, so same legal remedy can also be taken by the insurer, because he has paid the compensation. Now, he is at the same position of the insured. Then there is a principle of contribution. Principle of contribution says that the insured should contribute in the form of the premium, and if there are more than one insurer as well, if somebody has taken insurance from more than one company, it means all the insurers would contribute proportionately, not wholly, not the whole sum assured. Because why? Because there is a principle of indemnity. Again, this is not applicable in life insurance. Why? Because nobody can quantify life in numbers, in rupee values. There is a huge loss by the loss of the life. There is a principle of proximate cause. It means insurer would pay the sum assured only in case the loss has been caused by the insured event. Because if we say there is fire insurance, so it means fire insurance would only cover the losses which are occurred due to the fire. But if somebody has occurred some losses not directly by fire but by some other thing, so that would not be payable by the insurance company. This is also a principle of insurance. Now, you must be very confused that there are so many insurance schemes available in country. What are those? So, basically I have divided the insurance into two types. Insurance is basically of two types, life insurance and non-life insurance. Non-life insurance is also called as general insurance. Non-life insurance is also called as the general insurance. Life insurance, first I will discuss the difference between these two, then I would move forward. Life insurance means here the risk of life is being covered. Here the risk of loss of life, it means what? Death. It means what? Death. The loss of a person by death is covered by life insurance only. And if there are losses by non-death, it means non-life. So, if there are losses to a person not because of the death, by some other thing maybe there can be some illness, there can be some illness because a person is suffering from some severe or critical illness, there is some accident has happened to the person, there is some loss in the property of the person, there is some transit or the person has occurred losses. Why? Because there is loss of the maybe goods, and the goods were transferred from one place to another by rail, by ocean, by sea, by air, and that is why the loss has been occurred to him. So, these whole kind of losses are being covered by the general insurance, and the losses due to the loss of life is only covered by the life insurance. So, if I describe what is life insurance, where one party agrees to bear the loss of life of the insured, that becomes the life insurance, and where one party agrees to bear the loss not related to life but to some other thing, that is called as the general insurance. So, there are various kinds of life insurance products in India. Number one is term insurance. Term insurance means if a person survives during the tenure of the insurance, he would not get any benefit. It means there are two kinds of benefits. One is called as survival benefit and second is called as death benefit in case of life insurance. Survival benefit is also called as maturity benefit. It means there are two kinds of returns or two kinds of claims associated with the insurance product. One is death claim and second is the maturity claim. Both the two claims cannot be provided at the same time. It means one insurance can be giving you only death benefit, another can be giving you only the survival benefit. So, in the term insurance, term insurance, it is the purest form of life insurance which only covers the loss of the life of a person. Here the nominee would only get the death benefit. He would only get the death benefit. I should not relate the term by benefit, I should say death claim. So, on case of if a person has taken a term insurance, he would only get the death benefit as the death cover or the sum assured which he has taken in the insurance policy. So, there is no maturity benefit in the term insurance. So, this is for a particular period of time, that is why the name is term insurance. Then there are money back plans. Money back plans have two kinds of benefits, means the person gets a survival benefit after a fixed period of time and then gets the if somebody meets the death or there is non-life loss of the person, so then there would be the death benefits. But the positive point is that if somebody survives the tenure, then he will get the sum assured as well. So, there is the survival benefit as well as the death benefit. Then there are unit linked plans. Unit linked insurance plans are those where the premium is being invested in different kinds of investment avenues as per the need of the investor. It means they are similar to mutual funds. There are pension funds where the insured would get the pension, the sum assured as a pension amount or a fixed kind of income, maybe during his lifetime or maybe as a lump sum. Then there can be endowment plan. Endowment plan has both the things, survival plus death cover. It means that the person would get the survival benefit on the maturity of the plan, or if somebody has there is some unseen foreseen condition, then he will get the death benefit, as the nominee would get the death benefit as well. There is whole life plan. Here the risk for whole the life is being covered. It means there is no fixed tenure, that for this only duration a person's life is being protected by the insurer. It means that his whole life is being protected by paying the premium. So, it is also having both the things, survival plus death benefits. Then coming to the non-life insurance, there is health insurance. Health insurance is bearing the risk of health, bearing the medical expenses, the illness expenses, hospitalization charges, etc. In the motor insurance, the insured would get the expenses for accident as well as for the third party claims. In the fire insurance, there is the loss of property by fire is being protected in the fire insurance. In the marine insurance, the loss of property during the transit by sea, by water or air is being protected, is being provided. In case of property insurance, the property of the insured is being protected through the insurer in the form of shop insurance, in the form of home insurance, etc. The cattle insurance, the risk of death of the cattle is being provided to the insured in case of cattle insurance, and in the case of crop insurance, the loss of crop is being insured by the insurer. You must have heard about the Pradhan Mantri Fasal Bima Yojana. It is the crop insurance. These are some important legislations regarding the Insurance Act. There is Insurance Act 1938, which governs the regulations regarding the registration, regarding the investment, regarding the expenses, prohibition of rebates, powers of investigations, etc., relating to both in life insurance as well as the general insurance. Then there is General Insurance Nationalization Act 1972, which covers the insurance related to the non-life areas, health insurance, crop insurance, cattle insurance, property insurance, etc. There is Motor Vehicles Act 1939, there is Marine Insurance Act 1963. There are some important acts which covers the prominent insurance products in the country. There is IRDA. IRDA is the regulatory body which is Insurance Regulatory and Development Authority of India. It covers, it is a regulatory and development authority. So, it covers the both life as well as the non-life insurance industry in the country. It also covers the reinsurance. Reinsurance is also a kind of insurance, but it is not available to the clients as a retail product. So, the insurers can get the reinsurance. So, basically IRDA protects the interest of consumers. It is for the financial soundness of the industry, insurance industry, and it also responsible for the healthy growth of the insurance market. The various initiatives by IRDA, various regulatory measures of IRDA to cover, to regulate and to develop the insurance industry. So, if we see what is the current statistics of the industry, currently 94.71% is the growth of the market size of the insurance industry. So, we can say easily that in this current year the insurance industry is booming. If we compare both the sectors, non-life and life insurance sectors, so the contribution of private sector is increasing. In the life insurance it is 31.3% in the life insurance sector, and in the non-life insurance sector it is 55.80% contribution by the private players. And if you see the contribution of the products, so सबसे ज़्यादा there is a contribution of the this health insurance, this motor insurance and the fire insurance. They are contributing very much in the insurance industry. The next topic of today's lecture is equity. Equity is a source of financing. There are two sources of financing of the industry, equity and debt. So, equity is the money which is to be returned to the company shareholders if all the assets are liquidated and all of the company's debt are paid off. It is a long term source of financing. So, when a company is formed, so it takes money. So, the promoters they contribute the money in the form of the equity. Equity is also called as shareholders equity, which means total assets minus total liabilities. Generally, equity is issued to general public through IPOs and FPOs, and it is generally non-redeemable in the nature. These equity shareholders they hold the right to vote, and they also share the profits, and they also claim in the assets of the company, but yes, their claim is a residual claim. It is represented by the company's shares. There are different terms associated with equity: par value, face value and book value. As we have discussed, there are different kinds of shares. The shares are of two types: equity shares and preference share. Majority, if we say the equity shares are generally also called by the sweat equity, right shares, participating, non-participating, cumulative shares, non-cumulative, convertible, non-convertible, large cap funds, small cap shares and mid cap shares. There are blue chip shares, cyclical shares and defensive shares. So, there are various terms associated with the equity shares. But how we can trade them, how we can purchase them? We can purchase them through the primary market, through IPOs and FPOs, and we can also purchase them through the secondary market, through the stock exchanges. Then you must be thinking like, what is the benefit of purchasing equity? Why? Because equity are giving higher rate of return. Why? Because equity gives dividend, and dividend is announced on the profit of the company. So, there is no limit on the profits of the company. If profits are increasing, the dividend would be increasing and the returns would be increasing. On purchasing equity, you become owner of the company. So, it gives a satisfaction as well that now you are owner, you are participating in the managerial affairs and you are sharing the profits. There is tax relief on equity linked savings on the equity shares. So, you will get tax redemption as well, and these are marketable. Marketable means you purchase in primary market and you sell it in secondary market. Then what is the risk associated with equity? Yes, it is very risky. As I have said, there is high return. So, this high return is at the cost of the high risk. If a company is not performing well, so the dividends, there will be less dividends, there will be, if there are losses, so the losses are to be borne by the ultimate shareholders, who are the owners, who are the equity holders. There is no fixed income on the equity. Why? Because there is no fixed dividend, no fixed profit has to be shared. Then there is a residual claim on the equity. It means if the company is to be liquidated, the assets are to be distributed firstly among the stakeholders, then among the debt holders, and then among the preference shareholders, and the rest is being distributed to the equity holders. So, that is why it is said that equity holders have a residual claim. So, that is why also it becomes risky for investment. So, this is all about trading. These are my references. Thank you.